Hi everyone, I'm Karen Campbell with Next Home, and I have Kamber Kelly here with Cross Country Mortgage.
Yes.
And she's going to talk to us about the programs that they have to offer, especially in this crazy market that we're in now. And Kamber, if you can just tell us a little bit about yourself.
Yes. So Cross Country Mortgage, it was we acquired Lend US. So Lend US was a company that we've had in town since August of 18. And Cross Country Mortgage just acquired all of the Lend US platforms in April of this year. So formerly Lend US, now Cross Country, we're all the same. The team's the same, the underwriting's the same, just a new name. I've been in mortgage for about 17 years here locally, but can lend all over the US and hold special licenses in Arizona as well. So,
Great,
yeah.
Great. And you've seen some real changes lately,
Yes.
not just with interest rates, but also, I'm sure, just trying to get creative on how to get people into the right program.
Yes, it's super important for borrowers right now to start the process with a lender initially. I know that used to not be the case in prior years, and it's now become more of the norm, but ever so important right now that they start with a lender. Most of the time there are so many programs out there, and people can go to the internet and research all of these programs thinking that they know what's best for them, but after being with a seasoned lender like myself and having answered a bunch of the questions that we typically ask, it really can lead a borrower down a path of, oh, I don't know what really I'm going to do. The property that I find will kind of direct what way we need to go. So I just can't stress that enough. From a lender's perspective, it's not just meeting with the borrower. I really like to have the realtor involved in that part of it. Obviously the personal stuff, we go through that separately, but the realtor, you guys would really have a true picture of where this is really going to go. Depending on what the property is that they find. So
sure. And I like the fact that you're local here.
Yes.
You know the appraisers, you know the realtors, you just know everyone involved in the process.
Yep, we do. We have our appraisal, obviously we can't order them directly, but we have our own proprietary company within Cross Country Mortgage that our panelists ran through.
Oh,
so
good.
We do have a very good relationship with our third-party company. As it's proprietary to us. So,
Good.
Yeah.
Good. That's great. So what are you finding right now if you have a borrower that's struggling a little bit because of the interest rates?
Yep. So interest rates are scary right now. In fact, everything is scary, to be honest. History repeats itself, and you can go back, and I'm now getting old enough to have, I went through the 2008 to 2010 crisis, and I feel like, it's okay. This is just something that we've learned to deal with. New lenders, new buyers, somebody who hasn't had the savvy dealings of going through that period of time, they might be a little bit more freaked out, so to speak. But to me, this is just par for the course here. Presidential elections coming up in 2024, so this is okay. Everybody we just need to ride this out. It's going to get better. This is all normal. As far as the market's concerned from a mortgage standpoint, I always get the question, and I always say, that's really not my area of expertise, but from personally, I feel like it's going to be okay. I always get the question of, our price is going to drop? Is this bubble going to burst? And I always just smile and say no. We're not in a bubble. Billings wasn't hit like the rest of the nation was back in 2008 through 2010. We didn't, so we don't have to worry about that. I think our market is very steady from a lending standpoint. I have a ton of confidence in our community when it comes to builders and realtors and developers. In terms of doing what's right for the community. Okay, we are not going to get carried away. The other side to that is there aren't the bad loans out there anymore. Back in 2008, there were stated income, stated asset products that people could use to finance homes that had balloon payments, that had prepayment penalties, that had adjustable rates. those bad loans aren't out there anymore. In order for you, I say bad loans, I mean, yes, those were bad loans and they came due because the reason they were bad is they were given to people who couldn't afford it. Since that crisis, the government has came in and said, here is a bunch of new regulations that everybody has to meet. Therefore, we are not in a place where we have all of these bad loans that are going to come due. Okay, and if the market tanks, so to speak, people won't have a way to get out of things, out of it. We are not in that. We don't have loans with balloon payments out there that are the majority. The loans that have been written since then, as anybody who's financed, it is like, I need everything but your blood type and your birth certificate to get qualified and to get closed. So that's the one thing that I really want people to understand is, I'm not a realtor, number one. That's a question for you guys on what's the market doing. But from a consumer standpoint, I am 100% cool in terms of, no, I'm not worried. I'm not worried about my property value. I'm not worried it's going to drop.
Sure.
I'm not worried about making a bad purchase right now. We don't have the bad loans that will drive all of this down. Okay. So that's just one very, very important thing to think about from a consumer standpoint when you're looking at buying a home. From the lender side. From the financing side, if you're looking to finance a home, there is no way you're going to finance it if you don't really qualify. Okay. There are way too many regulations out there that essentially protect not only the investors but also the borrowers. We still have we're still in the day and age where most people qualify for way more than what they want to spend. So as a lender, it's super important to have those conversations about what your goals are, what's your goal payment, how much cash do you have right now. I don't want somebody to go into a home broke, and living month to month essentially. Sure. So there are a ton of conversations that need to happen up front, with the lender, with me, with my team, so we can best tailor and best fit somebody into a directive for you guys to go find them something.
Good. So that's great. So do you have any specific programs in mind?
So Cross Country Mortgage, most of the investors around the nation, I would say, have what's called a buy down. And when people think of buy down, they think of, oh, I'm just going to buy my interest rate down. Okay, that is not a buy down. Okay, when you're paying points to have a lower interest rate, you are essentially just paying a higher premium to have a slightly lower rate. So, for example, if you are looking at a 6.5% rate and the cost is 1%, okay, and you want your rate to be 6%, that cost might be 4%. Okay, so depending on your loan amount, that could be very costly, and it doesn't quite make sense.
Right.
It's not the biggest bang for your buck, so to speak. So what the buy down program is essentially is you can have a seller or a builder, the buyer cannot do it themselves, it's basically an interest subsidy program, and the seller, builder / either one of them, depending on who the seller is, can pay for that and subsidize the mortgage payment for a borrower over a certain period of time. Okay. So their Cross Country Mortgage, we have a 3-2-1 buy down, a 2-1, a 1-1, and a 1-0. Okay. So what that means is, let's just say 3-2-1, for example. Let's say we lock our rate in at 7%. Okay, on a 30-year fixed rate. Normal fees. We're not paying a ton of points to get that. Probably not paying any at this point to get that. But that 3-2-1, what that does is the first 12 months, your payment, you're paid back at 3% lower than what you locked in at. So you're actually paying your loan back at 4%, okay, as the borrower. The second year would be 2%, the third year would be 1%, and then the fourth year is when you actually even out and you're actually paying the actual mortgage payment that your note says.
Okay, so those are the discounts, 3%, 2%.
Yes, on the rate. Yes, discounts on the rate. Obviously, there's a cost for that because your mortgage is actually being amortized at 7% interest. So where it comes in and how we calculate it is We take the difference in interest between the 7 and 4, the 7 and 5, and the 7 and 6% over those first 3 years, and figure out what that interest difference is. So, for example, this is just one I have, a loan amount of $520,000. Okay, and you've locked your rate in at 7% on a 30-year fix. Your monthly principal and interest portion is about $3,450 a month. Okay. The first year, if you do a 3-2-1, you pay back at 4%. So your monthly payment drops, your principal and interest portion drops by almost $1,000.
Oh.
So your principal and interest portion drops to about $2,500 a month.
Makes it so much more affordable for people.
So we take that difference, we take that $977, and then you multiply by 12 months. And then we do that for the 5 and the 4%. So a 3-2-1 buy down on $520,000 at 7% interest is actually a cost of $23,845. Okay. So if there's room in a purchase price, if there's equity, if the appraisal comes in and it's way over what the contract price was, we can typically work some sort of buy down in. The buy down, that money, okay, a 2-1 buy down in this case is a little bit more easy to process. It costs about $12,000. Okay. So we would take that $12,000 that the seller would essentially contribute. They are the donor on this subsidy.
Okay, so the seller's paying for that.
Yes, the buyer cannot.
All right.
Okay, so the seller would be paying for that, and so that money is, we have to have it specifically worded in the contract that it's a certain, up to $12,150 towards buyers buy down, prepaids, and or closing costs.
Sure,
okay?
that's up to the realtor to
so visit with the lender. That money then at closing goes into somewhat of, think of it like an escrow account, but for interest. Okay, so you have your escrow account for taxes and insurance. Now you have this other account over here that the servicer holds, and it just has all of that interest subsidy. So when I make my first payment that year, for that first 12 months, I'm making the lower amount because of the buy down. So I'm making that smaller payment, but each month a portion of that to get the interest payable back up to where we locked at is coming from the interest subsidy.
Okay.
So the servicer still gets all of their money.
Sure.
Based on a 7% amortization.
Okay.
But the buyer pays it back at a lower amount for the first year. It is not an adjustable rate.
Sure.
Because there's a huge difference. Don't want to scare people with that word.
That's good to.
But it is a subsidy. Essentially, that is
that
is paid for by a builder or a seller.
And what incentivizes a seller or a builder to do that?
Yes. So getting properties moved. Okay. It is hard. It is very hard. I can't imagine how hard it is for you guys to comp out places because things are changing.
Right.
So fast.
True.
And you might look at something one day and then the next day something has sold and it totally takes a turn on a value that you've already comped out. So that happens, right? It happens. You have a property and you've listed it and you get it at list price, and then all of a sudden something closes after the fact, and that sale alone bumped up the value by $25,000. Okay, so while these buyers are under contract at 500, okay, and now it appraised at 525, the buyer can essentially go back to the seller and say, hey, we really want to take advantage of this program. We have the equity, we have the value, the home's going to appraise because we already have it, so to speak, and they can increase that price to help cover that buy down. Okay. So keeps the properties moving.
Yes.
Helps the buyers buy.
And it doesn't hurt the seller.
No.
Okay.
There's no recourse. There's no recourse for a seller. That subsidy, once we've closed, the sellers sign one document. That's a lender document that basically just says that they're the donor of the buy down, and that money just goes into the subsidy account, and the seller has nothing to do with it after the fact.
So Kamber, question on that. Yeah. Do you normally see this opportunity pop up for the buyers when it's that far into the negotiations? We've already hit the appraisal, and now they come back and they ask
Super,
agent,
yeah,
the realtor
super
to
easy
negotiate
fix.
that.
Super
Okay.
easy fix.
Do they ever do it in the very beginning?
Yeah, oh yeah.
Okay.
Yep, sometimes
so-
we will have, like, it's absolutely adamant. And the reason we look at this buy down is because we know the rates aren't gonna stay at 7%.
Mhm.
We know, like I said before, history repeats itself, right?
Yes.
I think out of the last 22 recessions, 19 of them, property values have increased.
Sure.
We've never had a decrease in property values, we've always had an increase.
Yes.
So history repeats itself, and if I'm saying, okay, I have this home that might be a little bit over my budget right now because of where rates are, but you take that back down to what's normal, and once our economy recovers, it's going to happen. It's just a matter of when.
Sure.
It could be as early as next summer.
Mm-hmm.
It could be as late as Q1 of 2025 after the election. Who knows? It's going to happen.
So what happens then if the buyer decides they've taken advantage of this program, they have an affordable payment,
Yep.
and now they've decided rates are coming down, or whatever,
Yep.
they've had an event in their
Yep.
life where they feel like they would like to refinance.
Sure.
Can they do that, or are they locked in for
Nope.
those 3 years?
They can absolutely refinance.
Okay.
Any money left in that interest subsidy at any point in time, there is not a prepayment penalty, there's no penalties to just take that money. Let's say it is time to refi, and I can get you on a 4% fixed on 30 years. Yeah,
Mhm.
we should do that,
Mhm.
right?
Okay.
So anything left in this interest subsidy account will be applied as a principal reduction on the payoff, and we get to take advantage of that on the refi.
Great. And
Yeah.
again, the seller, they're out of the picture
They're
at
out
that
of the
point.
picture. Mhm.
So,
It's really, there's no recourse for the seller. If it's negotiated in up front, it needs to appraise, obviously, the home needs to appraise, which is why a lot of the times we do put them in up front if it's an absolute, like, it has to happen type deal. Or we do come back after the fact and, hey, I have the appraisal and it came in $20,000 higher. We don't need all 20,000s, let's
Right.
say I only need 5 or 6 because we just want to do a 1-1 or
Sure.
a 1-0.
Okay.
We'll make whatever we can work to benefit the buyer in this case, so we can hold them off at these higher rates and give them a little reprieve until we can get it refinanced.
Yeah, this is great. And I think from my standpoint, it seems like it's all about education.
Yes.
Educating the realtors, educating potential buyers,
Absolutely.
and certainly the sellers, so that
Yes.
everyone understands the benefits and the timing, I guess, on
Yeah,
everything.
the education is huge. I can tell you I've spent countless hours on the phone, not only with just my buyer's agents, but also listing agents to help them understand. And had people in the office just kind of going through it. Here's how it works. Here's how you can use it to help you when you're marketing. Instead of doing a price drop, why not keep it up there but offer a subsidy for the interest buy down?
It's very, very interesting.
Mhm.
Is this something that, is it relatively new?
No.
Okay.
Here's why we don't know about it, or here's why it hasn't been used a lot. When rates are at 5%, the buy down is going to be, the investors will price us out to where the buy down makes no sense. They don't want to do a 2-1 buy down so your rate's at 3% the first year. When rates were at 3%, they're not going to do a buy down. They don't want to offer a buy down, so they're paying back, so it's a 1%. Okay, so what happens is the loan level price adjustments that are put out with pricing to people like me, like lenders, from my investors, those LLPAs adjust. Okay, so when we're at this rate environment right now, it absolutely makes sense. And the LLPAs are super, super, super low to do that, to take advantage of the buy down. When rates are at 4-5%, those
Doesn't make
LLPAs are going to be a lot higher, and it's going to essentially price you out of wanting to do the buy down.
That makes sense.
But we'll see what happens, because rates are going to come down. It's just a matter of when. Fannie Mae has flat out said it. So
good.
yeah.
Well, that's
And we're going to hold them to it.
So, that's
yeah.
great.
Yeah.
So, do you feel like this program sounds like it would be good for just about anyone, as
Yep.
long as the house appraises
Yes.
for more than
I
the
mean,
original purchase price?
Yeah,
I guess, is how
as
I would
long
put
as the house appraises at contract price, if the buy down is negotiated in.
it.
Okay, so it might be that instead of doing the price drop, you leave the price as is, but you've given a $15,000 subsidy. So instead of dropping the price $15,000, you've kept the price there, but will allow this $15,000 buy down, or concession to the buyer.
Okay.
In the events where it wasn't negotiated in upfront, and I've had conversation with the client that this is what your payment's going to be, this is what we need to live with, this is what we need to budget for right now, and then the value comes in higher, then we can go back with an addendum and just say, we would like to increase the price, and this is how much we want for the buy down.
That's great.
So yeah, the seller, it has to be specific amount to remain compliant. It can't just be it can be a general number, and I can use so much towards the buy down and then the rest towards something else, like the other closing costs or something, but it does have to be specific or because of the documentation to remain compliant.
So do you find this to be good for all different types of buyers, first time home buyers as well as?
Yep, so you can't use it on an investment property. It is only for an owner occupied or second home.
Okay. So it will work for a second
Yep,
home.
it will work for a second home, just not any investment properties.
All right. Okay.
You can do it on an owner occupied multi-unit. So if you find a duplex, triplex, fourplex, and you're doing some sort of financing in which you're occupying one of the units, you can do the buy down on that.
Very good to know that. So is there a price limit? I mean, if I'm buying a $2 million home, can I use this program?
You can if the investors allow it. Yes.
Okay. All right.
Yep. Typically, it's when we get into that jumbo and the non-qualified mortgage stuff. Those programs, they're less apt to accept the buy down options, just because there's other caveats there that they're foregoing, other parameters I should say that they're foregoing, no mortgage insurance and allowing 10% down, just different things that aren't within the normal box of Fannie, Freddie, and HUD. Okay, in terms of underwriting guidelines. So we might be limited on that a little bit, but
but we see these are pretty common with
standard
the average buyer.
Yep.
Good to know. Well, thank you, Kamber. I really appreciate your time today. Is there anything else you can tell us about the program? If we wanted some more information, is there some
you can just reach out to me. My email, cell, everything's online, of course. Just don't read all the stuff about mortgages online. But you can find my information online. My team, I have a junior lender at the office as well, who's very knowledgeable. So great. Just reach out to any of us at Cross Country.
That's great. Thank you so much.
Yeah, you're welcome.
All right.
How long was it? Let's
find out.
Did I go fast enough?